Welcome to Galaxy Brains, the weekly podcast from Galaxy Research. I'm back with a track that attacks your weak nerves, and I'm down for the sound money, bound to these verse, and I'm king with the ring, pulling strings of these purse. Deserve more than the Biebers, know that it never bothers me that hide meanings deep into these verse, so you should call it cryptography rap. Put my haters in the tar, kick up dust with my heels, cause you know I take care with the lines that I feel. Don't push me, all of y'all are rookies. Buddhist when I do this on chain, Lucas Nuzzi. Whoopsie daisy, floating like Swayze, ghosting every baby who wants to try to fade me, phase me, tase me, send it over lightning, rating every enemy, Bitcoin Viking. As always, I'm your host, Alex Thorne, head of firm-wide research at Galaxy Digital. Thank you for listening to Galaxy Brains. We have a great show for you today. As I said, Lucas Nuzzi, head of research and development at CoinMetrics. He's our guest. He's a repeat guest, and it's a great conversation with Lucas about the topic of this week, which is crypto data and analytics. We're going to get into it with Lucas about new products CoinMetrics is offering, talk about the ecosystem and usage of on-chain data, and it's a fascinating discussion. But we'll also talk with our good friend Beimnet Abebe from Galaxy Trading, as always, to discuss markets and macro. Before we get to that, I need to remind you to please refer to the link to the disclaimer in the podcast notes, and note that none of the information in this podcast constitutes investment advice or an offer, recommendation, or solicitation by Galaxy Digital or any of its affiliates to buy or sell any securities. Yo, we got Phineas mic'd up. Welcome to the show, Phineas, our producer, longtime producer. We got you on camera, man. Welcome.
I'm honored, Alex. Thank you for having me.
I love it.
Giving me a microphone almost, as we approach episode 100 in a month or so.
Yeah.
I appreciate it. I'm excited to be here.
Yeah, it's been a long road, and Phineas is essential to this show, and I figured it's fun. I love we get some behind-the-scenes look, and we'll chit-chat with Phineas sometimes. But for now, let's get right into the show. Let's go now to our friend Beimnet Abebe from Galaxy Trading. As always, Beimnet, thanks for joining Galaxy Brains.
Thanks for having me.
So we're still just ranging in Bitcoin. I'm seeing dollar strength, bond weakness, equities struggling what's the vibes in markets right now? What's driving the story in markets?
I think that there's a lot of fear around the implications of higher for longer, right? Folks in the equity world are like tech stocks. If you think about them as dividend-paying companies or a stream of cash flows over time, just functionally as interest rates go up, you've got to discount, the value of those future cash flows more aggressively. And two, like, what does it mean in the context of like relative value between bonds and equities, and like from a risk-adjusted perspective? Would you rather earn 4.5% on the 10-year for 10 years with no volatility, or
right,
guaranteed 4.5%, or own some of the single name equities that you can? And then the question is, higher for longer, what are its implications for the broader economy? Does the consumer slow down? Does the economy slow down? And if you think about what the Fed is actively trying to do, they are trying to slow the economy down with monetary policy. So if this monetary policy does have its, desired effect, like, it should be bad for stocks. And we do know that, there are certain things that are ramping up that should hurt the consumer. Like, we're now basically in October. The student loan repayments are about to begin.
Right.
In addition to that, gas prices are actually a tax on the consumer at this point, right? And so if every time you're at the pump, you're paying an extra $20, you're going every week or every couple of weeks, that's going to start chipping away. And so we know that over time, we'll start to see the consumer balance sheet kind of dwindle. However, the counter to all of this is that, the Fed still only cares about, the level of inflation. And so when gas prices go up and like other things related, like that drives, inflation higher, and that might drive the Fed to more hawkish policy, which isn't necessarily, what they do. But long story short, there's just so many variables at play. Like, the United Auto Workers are at strike. Right. And so labor's got a lot of power right now, and wages might be going up because we're in a structurally tight labor market.
Which can contribute positively to inflation, right?
Yeah. So we're in this weird dynamic of, we know things are slowing. Nobody wants to buy a house right now. Mortgages rates are like super absurd. That I think is on the cusp of, some
Something
change.
to give, yeah.
However, the data is still like super strong.
Yeah.
Right. But consumers is going to slow over time. Their savings are dwindling. Credit card delinquencies are picking up. Auto delinquencies are picking up, et cetera. And so we've got to find the balance between knowing that stuff is happening and, the fact that the inflation metrics that the Fed's focused on haven't necessarily bottomed or aren't anywhere close to like where they need to be for the Fed to kind of ease.
Right.
So it's really tough. And then you throw in just the fiscal side of things, and it's just so insane.
Yeah, and
the mountain of treasury supply
Yeah.
every single day. Not every day, it's their settlement days, but you get treasury supply every Tuesday and Thursday on bills, every mid-month refunding and treasuries and month-end refunding. Then you've got the tips. There's so many. I was literally looking through a net maturity / cash addition table the other day, but it's literally like every settlement day, it's like, oh, here's another 15 billion in marginal, 10 billion there, 4 billion. Like it just adds up over time. And the Fed isn't actively expanding its balance sheet right now. But anyway.
Yeah, it is very complicated. I mean, your point that, the economy easing, should be supportive for inflation and thus supportive for rates to halt or eventually come down.
Yeah.
But at the same time, other forces in the economy keeping inflation steady.
Yeah.
Right? Like the tightening in the labor market, the housing market, the new the consumer the spending that's the United Auto Workers is an example of like labor power on the labor side, negotiating power, right? There's that, what's that metric of the average amount of money that like people would need to take a new job now, right? Like everyone's demanding more in wages.
Yeah, the average like shift, like job shifters.
Yeah.
They actually pick up, I think, around 5 to 6% increase in wages,
which is high on the historical.
Yeah, super high.
So it's tricky, and then when we think about we have the government shutdown too. You're talking about the fiscal side, right? We also, in addition to lots of spending there, we also have impasses, which make effective governance more difficult.
It's so crazy. And then you throw in like I think a banking system that just like is not healthy.
It's stretched still.
It's stretched because what's happening is, when we had the Silicon Valley signature banking crisis, we had it because all of these banks had all of these treasury securities and other long duration
they just went
assets.
down in value.
They've gone further down in value now.
And they couldn't hold them to maturity to get that liquidity back. Because
they were going to get rushed by a run on them. So they put it on in this BTFP facility. But at this point, like, everybody is now realizing that BTFP facility is permanent. Yeah. The value of those securities is only
it just has to hold them through maturity. Basically, there's no other option.
Well, so
that's how long is that? I mean,
or interest rates need to come down,
right?
And those assets recover in value, but that's not happening,
right?
And so
not in higher for longer.
The Fed basically just created a new long-term lending facility that's like a permanent feature of the banking system. Right, because of just how twisted they got things, by forcing banks to own all these treasuries, then hosing them, because they created an inflation problem by not reacting aggressively enough. And so you're just in this weird situation, and now there's a huge, intense competition for deposits,
right?
And that's crushing these bank margins, and they're going to have to post more capital to operate. What does that mean? They're going to have to issue more debt.
It's a vicious cycle.
It's so bad, and the issue. I hate to like blame regulators and the Fed because it's tough to put yourself in their shoes,
sure,
and to understand all the various dynamics happening. But for the BTFP, like you could have known day one.
The second you start hiking, you mean?
The second you start hiking, they could have known about the banking crisis sooner rather than later. But not even that. But it's just the way that this facility was, constructed. Like, it wasn't the most honest at the beginning. Like nobody told you that it was going to be a permanent feature of the banking system when they initially launched it.
It was an emergency 1 year thing.
Emergency 1 year, we'll be fine. But no.
Yeah, tricky.
And so, and the other thing is just like, let's just be honest. Like, the government can't afford 4.5%, 5%, 6%.
Right.
Like, interest rates with these levels of deficit.
Oh yeah. There's all that stuff about the cost of servicing the national debt.
The debt, and it just keeps ballooning, and like it's all like this market is fundamentally built on the premise that the money printer will just go brr when necessary.
Yeah.
And it's just such an absurd concept. And it's like the only reason you can do it is because everywhere else is even shittier.
Yeah, right.
That's realistically, that's what the whole essence of like the U.S. financial system
and the dollar,
and the dollar monopoly, like right now, come down to is
it's the lesser of all the evils.
It's the lesser of all the evils because
Yeah.
everywhere else is housing affordability.
They have the
is way
same
worse.
problem, yeah.
Same problem,
And worse.
because they don't have the currency benefit.
Right. It's tricky, and I always love talking with this. Let me shift gears just a little bit because
Buy Bitcoin. Sorry, I didn't say that.
Our guest this week is Lucas Nuzzi from CoinMetrics. We're talking a lot about crypto data. As a trader of crypto markets, like how do you think about data? What types of data in crypto are very important to you? Just types of data.
Funding data, open interest, volumes, all the same metrics.
All market data stuff
that are relevant to any marketplace. I think all markets are essentially identical, right? There's buyers and sellers. There's types of buyers and sellers. You have to figure out, who's motivated to do what. Right. There's options positioning. Right. Are people short gamma, long gamma, vol, short vol, long vol? Right. Then there's the funding side. Like, are people paying a lot to be long, or people paying a lot to be short?
Right.
And then there are catalysts. But basically all markets in my head at least function on the same set of things. So I look at basically an identical kind of set of metrics.
What about like on-chain data?
On-chain,
you have fundamental data obviously, and like at the macro level, you talk about a lot of that all the time. You obviously can look at individual companies; they have reporting schedules, but is it impactful to you that it's more real-time, transparent?
It's so much more impactful. I mean, you can literally see movements on chain from wallets that you track, from great traders or from market makers or from venture people that are dumping, and so you can see their tokens going to exchange and being sold. Right. And so it's an paralleled level of transparency.
Tracing flows for you as an on-chain thing, yeah.
Yeah, it's great. I again, like, the question is, like, in the biggest asset in the space, Bitcoin, it's not really that relevant to track. The government wallets are really important, etc.
Miners maybe, but we know that.
But in things that are super macro, not necessarily important. Like if I told you I could track people's trading of Eurodollar, right? Such a huge, massive macro asset. Which account's doing what? I don't even know if there's a signal there.
Right,
like,
just because it's such a big macro asset. Bitcoin's trading more as a macro asset.
More of a macro asset.
But for a more crypto native flows, the on-chain stuff is useful?
Yeah, I would say, yes.
Very interesting.
For a $300 million,
like
ETH DeFi token, right? That's held. The top 10 holders own like 30% of the
Following that flow is really important.
That's more important. In those instances. But I think crypto analytics and on-chain analytics. There's a ton of service providers out there that do a great job. Yeah. And folks have tried to build signals off of it and stuff. And I think, like with anything else, it's really tough, and only a handful of people really figure out the secret sauce.
Interesting.
Yeah.
Beimnet Abebe from Galaxy Trading, my friend, as always, thanks for coming on Galaxy Brains.
Pleasure.
Let's go to my friend Lucas Nuzzi from CoinMetrics. Welcome back to Galaxy Brains, Lucas. Great to have you here.
Likewise, Alex.
So the last time Lucas was here was, he wasn't actually here, we were remote, but he was on Galaxy Brains in November or December of last year, talking about FTX, because Lucas had done a lot of research to show money movement in and out of Alameda and FTX accounts that was, troubling. Yeah. And we talked a lot about that. Have you kept following FTX? Is that saga from a research standpoint over finally for you?
At least on the on-chain side, it seems to be over. Yeah. But yeah, that was a crazy 3-month period in our lives at CM, just because of the breadth of data and deception.
Yeah.
And
the scale of flows that you were uncovering was just huge.
Just absolutely insane. Billions and billions of dollars going into DeFi, into other exchanges. I guess one of the things that I've found that I haven't really shared just yet are the other recipients of the FTT ICO. I did some work there because that's the whole reason why I found that 4 billion transaction from Alameda back to FTX that looked like a bailout was looking at the ICO recipients. And there were some other entities there that basically send funds to FTX, likely because of other deals that they did as they were seeing the situation with FTT get progressively worse. So I'm excited about the court hearings.
Yeah,
the trial.
They start October 3rd. Sam's trial starts, and I'm told, although I haven't actually independently confirmed this, but people are saying Michael Lewis's FTX book apparently drops also October 3rd.
Oh, that's interesting.
So we're going to have to read that very quickly, I think. Yeah. I mean, I'm going to have to burn through that thing. So Lucas is head of R&D at CoinMetrics.
Yep.
So what are you researching and developing these days? What's interesting to you? What are the opportunities and challenges in crypto data?
Yeah, data in crypto is pretty tricky because it's almost like tracking within a single company an entire financial system, right? So we have mostly we want to categorize things into 2 buckets. You have market data, which are prices, volume, things that are happening on centralized exchanges. And then you have the network data, which is where I focus the majority of my time. So looking at these actual ledgers, understanding how they're getting used, how these networks are getting used, supporting new assets, which is always a pretty tricky part of our process. But recently, I've been taking a lot of doing a lot of work around mining.
Mm-hmm.
There's been some interesting developments in mining as an industry post FTX collapse.
Yep.
And I think there are some interesting changes happening there. And I think we're at this pivotal moment for mining as an industry. We recently released a new set of data looking at specific ASIC models and understanding the breakdown.
Yes, I love this data set. Let's talk about that real quick. So this stems out of Kareem Helmi's NOS Analysis, obsession, I'm going to call it.
It's an obsession.
Right? Yeah.
It is.
He's the only one on earth that is obsessed. Well, but not anymore because, maybe you can explain what is the NOS analysis concept, by the way. How are you basically you're looking at hash rate and actually you're looking at blocks that are mined, but based on how some quirks in the data, you can actually figure out and fingerprint which machine model mined it.
Yeah, which machine?
How does that work? What is the data? What is
block?
the nonce? Explain this part to me.
So nonce is short for number used once, and the nonce is basically what Bitcoin miners are trying to get when they're mining Bitcoin. So the ASICs, the machines that are highly specialized, used in the context of mining, they're trying to find a nonce that will meet some pattern that is required by the system so that you can actually include a block.
Which is the difficulty adjustment, basically. They have to find, and I think the way Bitcoin works to make it harder is actually just adds and removes leading zeros from the output that's required, whatever, to make it an infinitesimally large or small number, basically.
Exactly. It's a very clever system.
Yeah.
If you need to find more zeros that in the beginning of that hash, then you have to have more compute power. And that's a way that Bitcoin adjusts for more miners coming in, miners leaving.
Right.
And the nonce is that special number. One analogy that I like to use is, we think about mining because mining as an industry, as a very human, 1,000-year-old activity.
Right.
It replicates from an economic perspective like what Bitcoin miners are doing, right? You're trying to allocate resources into this process, and if you're lucky and you have the right equipment, you're finding new Bitcoins and you're rewarded for it, just like when you're mining for silver or gold. But mining, when it comes to the actual process of what's happening under the hood for these miners, it's not the best analogy. I found that locksmithing is maybe a little bit better. So what miners are trying to find is basically a key to a lock that is locked, and they're competing to find the key that will unlock this lock. And that key is the nonce. Mm-hmm. Because once a miner has allocated enough resources to unlock that lock, produce a key that unlocks that lock and enables them to add a new block and lock it again to the blockchain, that key is the proof of work. They've actually went through the effort of producing that key, and they can share that with anyone that wants to verify it. And it's very easy to just try and unlock this lock. And if you have the key, the lock will unlock.
Right.
So the nonce is really that key, and it's unique for every single block. And you can think about, the ASICs as these, metal grinders that these miners are using to find these.
But they end up having, even though certainly to the human eye, these hashes, these keys end up looking pretty randomized or whatever.
Yeah.
Actually, what I think Kareem first discovered on like the S9s or whatever he first looked at them was that there's actually a pattern. Different machines tend to like find not certain types of nonces or something, right? And that with like some kind of crazy big machine learning analysis, you can actually figure out those patterns. And for a long time, you guys have offered the data. Kareem worked at CoinMetrics, right? That's what he worked on when he was there. He worked for you, right?
Yep.
So, and you had that data for the S7 and the S9, the Antminers, I think, right?
Yeah, and those were, this stems from a lot of work.
You guys called it too, like what, the ghost in the machine too? Because no one actually really understands why they're different, why there is a pattern, right?
There are a couple of theories as to like why is it that each key and each block is different. And it was difficult to identify these patterns to begin with because although we knew these patterns existed, it was hard to match a pattern with a specific machine.
Right.
And, back in, I think it was 2021 when we first released the first set of metrics around S7s and S9s.
Right.
We knew the pattern had existed. It was initially this collaboration between Kareem, myself, and Antoine Lecove at CM.
Yep.
And we knew that depending on the ways that you would encode the nonce, you would find some interesting patterns that matched release dates for the S7 and S9s.
Oh, wow. So that's how you started to realize.
Yeah, and just sourcing the nonces on-chain and basically matching that with
when they
big
first
release.
appear and when you knew then that a machine was released in the public.
Exactly. And,
okay, well,
we
it could
started
be from
seeing,
that. Well, yeah.
Yeah, it wasn't exactly when they released because
They do
as
the
we learned,
pre-mining or
Bitmex-
whatever. Yeah, they test them. They test them before they send them out.
live, sometimes for a little bit longer than they should have.
Right.
But so we found S7s and S9s. And then Kareem, because it is an obsession, continued that work. And he's found a really clever way that we had originally talked about, at CM of how can you really expand the set of nonces beyond the blocks that are, being found on blockchain on average every 10 minutes. But how can you really expand like your training set so that you can have more models that might be a little bit.
I see, because there's 806,000 blocks, but that's not that big of a set.
It's not.
And by the way, like the first 5 years of them are irrelevant. They're not even ASICs, right?
They're computers.
Yeah.
And some of them also have patterns. Satoshi has left a pattern in some of the early blocks.
Yep.
But we found that Kareem actually implemented this and spent a ton of work on and time on this. There are ways that you can just rent these ASICs and just sample them to
just
the point that
hash
you
them
have
a whole bunch and just see what comes out.
You expand the set of nonces that are produced by that ASIC.
I see. So you look directly at the models hashing rather than just the public data that becomes part of the blockchain.
Happens and then you can connect the machines without just relying on things like
you can test
release
them
times.
Right.
Now, because machines might be released concurrently, and
right.
This is a substantially better way of understanding that.
And so let's fast forward a little bit because I want to get to some of the really interesting takeaways for this. So doing this, CoinMetrics and Kareem were now able to fingerprint basically all machines. And so now, which has a lot of interesting implications, but this I think in some ways the most obvious one is, well, let's say you're in the ASIC manufacturing business. We can kind of see a real-time and historical market share of all the models. We can know like how many of S19s there are and how many S9s there still are and how many WhatsMiner whatever M20Ss there are, right? Like that's really interesting market data that does not exist in like other industries, right? There's no way you can just like real time see like every single person's GPU that's playing Call of Duty. Like,
exactly.
It's really interesting.
Especially for hardware, right? For hardware, you don't really have this common network that you can source data from and understand the predominance of specific machines. So I think that was fascinating in terms of understanding not only the differences in composition in the network and how kind of diverse it's getting from a model perspective.
Yep.
Understanding, for example, what it takes for a model to take off, and at times, the XP, for example, took a little bit longer to become predominant, and really just add a little bit more context to what's happening in mining right now. You had a lot of pools and constituents, individual mining operations, change their ASICs, restructure in the bear market, and you can see that happening and changing the composition of these machines.
Yeah,
as well.
you found something where it's like, say some big miner like closed down some big site or got acquired by somebody or whatever, and you actually see like probably while the ASICs are being put on a truck, there's like a decline in one specific. Have you noticed things like that?
Yeah, and you can see that in the different aggregation windows. So we have, if you go to labs.coinmetrics.io, you can see the breakdown of the machines. But we have different aggregation windows that we're testing with. And if you shorten the aggregation window, you can see the model becomes more sensitive. So you can see, for example, when there's a high likelihood that the biggest user of the XP has unplugged, and it's probably because they're moving operations somewhere. So different aggregation windows enable you to see this, and we kind of capture this not only the migration from China back in 2021, where you had some models kind of drop in usage and then pop back up, but even with this latest kind of restructure in mining, you can see a similar effect happening.
So one of the other really interesting analyses and conclusions that you guys drew from this data, which is really fascinating, is a much more empirical assessment of Bitcoin's total electricity usage, energy usage.
Yeah.
Right, because you have Cambridge, the Center for Alternative Finance at Cambridge University, and theirs is based on polling. They literally ask some pools how much they're using or whatever, or what their hash rates are and where they are, and then they use it's not real. They don't actually have electricity information. They know this. They admit this.
They're very transparent.
And it's very good. It's a very good data source. But it's extrapolated. It's based on a bunch of assumptions, et cetera, right?
It's the extrapolation. That's the issue.
And then you obviously have Digiconomist, who I don't know what his methodology is.
It
but
hasn't
I don't
been
like
the same.
It
hasn't been the
He's changed
same.
it a bunch of times. He did say that it would use all of the world's energy by 2020.
Yep.
That obviously did not happen. But now you have a way, because the proportion of every model on the network at any given time historically.
Yeah.
Well, we can also go look at the specs of the model. We know how much electricity it uses, right? So now you can actually sum a much more accurate measure of how much electricity Bitcoin is using, which I really, really like that they have. Now, we don't have to listen to these people making stuff up in the Netherlands or Cambridge doing their best, but it's just sort of like a poll. It's not actually a data-driven exercise. Now we have some hard data, and that's, as you know, of course, that's one of the biggest, not just criticisms, but issues around Bitcoin, and both in the crypto world, but in the scientific community, in the climate community, in the mainstream, right?
Everywhere, yeah.
And now we actually have something real.
Although one of the areas that I was most interested in was the breakdown of machines. I think the biggest impact of this data set is on the electricity consumption fronts, because we had a varying degree of intellectual honesty in previous assumptions. I think Cambridge was very honest about the shortcomings of their model.
I agree.
Digiconomist was not.
It was not. And then you have the Bitcoin Mining Council, which I think is honest, but is also a limited data set.
Data set. Now you can see, because now you have this composition of ASICs in a network, from a much more precise perspective, what is actually the consumption. And what these other models really didn't take into account is the insane increase in efficiency that new machines have introduced.
Mm-hmm.
So if you're making blanket statements about the efficiency,
rate.
exactly, how many hashes can you produce with the same unit of electricity, you're massively really not taking into account the increase in efficiency that new models have introduced, and it has no signs of actually slowing down, which is fascinating to me, because
people were thinking. I remember hearing 5 years ago, smart people had a thesis that, not all smart people, but some people who were smart and are still smart, thought that mining hardware would become commoditized quite shortly. That like actually there would essentially reach peak efficiency, and then then the game would be played solely on OpEx and build outs and other ways to gain efficiency, even software, right? Even like, but that's not the case. They keep getting faster and faster.
Faster and faster. It's been really, even my expectations of marginal increases in efficiency was underestimating the speed through which these new miners and efficiency, the underlying electricity consumption that's taken to produce hashes. So I think that was one of the biggest takeaways, and the ultimate impact of increases in efficiency obviously is less electricity.
Right.
So at times we're half. If you look at the actual machines on the network, it's half the consumption than what Cambridge and certainly other less honest sources like Digiconomist had estimated. And we think that this is really important because there's a lot getting discussed right now around mining policy,
right,
and using just bad data,
right.
So
you just want the correct data.
You want to speak, and if you accept this increase in efficiency, and if you understand that this increase in efficiency continues to happen, it doesn't necessarily mean that as Bitcoin grows and its security expands, that your consumption will increase accordingly. Consumption can start tapering while efficiency and hash rate are still going up. And before, I think there was this mental model that when people were trying to reason about Bitcoin's electricity consumption, that all these kind of move in tandem, which is not
some kind of linear relationship.
Yeah,
it's really interesting data. Definitely check that out at labs.coinmetrics.io. Let's talk about a couple other things here. I really did love that data, by the way. I was so proud of Kareem for this was.
Likewise.
You're watching Kareem like I can't believe you pulled this off after years of shilling this concept. He's
yep. He's done it.
Yeah, it's very cool. And so, but you also look at other stuff.
Too,
what else? I mean, there's more data, crypto data vendors and projects and block explorers and free websites than there has ever been before.
Yeah.
What do you think of the state of crypto data? Is crypto data ready for like the institutions? Like, are they coming? Are we like what level of quality and depth and analysis are we getting out of the crypto data world these days?
Yeah, it's been interesting because there was a lot of specialization that's happened in crypto data as well, and I think it's a factor that stems from the fact that you have a lot of different areas of interest in the industry. You had like even data providers that were focusing on NFT markets,
right? Only NFT data.
Only NFT data. Yeah. Now we have new entrants that are looking at real world assets,
right,
and specializing. And I think it stems from the fact that you have a ton of data. The transparency of these blockchains, the byproduct of that transparency is really a ton of different areas that you can start monitoring. But because our clients are mostly institutions, we have to be a little bit more careful, allocating resources to things like NFTs, for example, because there just isn't a lot of demand for that type of data from that institutional perspective.
Yep.
But I think the state of crypto data today is a bit confusing because we really don't know what is going to happen, market-wise, if these layer 2s that can be very difficult for data providers to integrate will stick around, right? If projects that are even more challenging to support, like Solana, will have like long-term feasibility. Solana, for example, it produces more data in one day that Bitcoin produces an entire year, although that might change with ordinals getting more predominant in Bitcoin.
Yeah.
So the decision of where to focus, I think, has never been like this challenging in the field of crypto data. But a lot of data providers are still around focusing on different areas. We tend to have a more conservative, like quality-oriented approach to our data strategy. Because of the expectations of our clients. So that prevents us from, going all in into, new layer 2s. The time needs to elapse and the need to actually get real usership and interest for us to actually go and monitor them. But I would say that there are some areas that are not controversial at all and that we're focusing on. There's a lot in stablecoins today that folks are really interested in, and it's one of those rare intersections between what institutions are interested in and what the crypto native folks are interested in.
Right.
Stablecoins. So we're focusing a lot on not only expanding stablecoin coverage with new projects, but also thinking about additional data points that will be a requirement for stablecoins. Like there are projects that are trying to basically tokenize treasuries, right? And that entails yield.
Right. How do you track a yield metric or whatever? Right. Yeah.
It's almost like a new. It's almost like a new financial product in a lot of ways, because it's almost like you're tokenizing your deposit at a bank in your checking accounts, and that unit is rebasing as you're getting more interest.
Right.
So it entails, like from a data perspective, a lot of challenges, but those are the areas that I think are less controversial that we need to focus on.
Totally. I think that makes a lot of sense. I mean, the stablecoins are objectively widely used, right? And they're interesting. They have some features that are better. They're not volatile typically. Well, knock on wood. Yeah. The good ones that function properly typically don't have price volatility, which is great. Yeah. So it's like it's money with wings. It's like dollars that you can send globally, right? I mean, I don't know if people have ever tried to send dollars to like another country. It's very difficult.
It's painful.
They're not on Venmo. They're not on Cash App. I don't know why. Apparently, all those things are just national borders, basically. Right. Well, I do know why. It's jurisdictional, right?
There's a huge issue
but
with jurisdictions.
Public blockchains are global.
Yeah.
Of course, they're typically collateralized. I would be interested to see, as you guys build out too, like there's a wide variety of how they're collateralized. Like if Treasury is off chain, one thing, but then you got like Maker, which is all on chain, and then you got Frax, which is like half collateralized, right? They're quite different. So
they're testing different models for stablecoins now, and I think the toughest part of understanding stablecoins and even around their coverage is that use case. Is it actually getting used for payments? Because if so, the metrics that you would use to contextualize stablecoins is different, right?
Yep.
What is the actual underlying use case for a stablecoin? In DeFi, it does get used quite frequently as a stable store of value.
Yep. Because
you might not want to rely on your local banking system to actually get fiat that's less volatile than
on and off ramps in and out of crypto could be difficult. Yeah,
very difficult. But some preliminary data, and we've written about stablecoins quite a lot. But a big one is as a collateral type, right? Because it's a stable form of collateral, and you can get leverage in a risk minimized way, and that's one of the ironies of crypto at this stage,
the old
right?
Bitmex, right? Bitmex you could only post Bitcoin as collateral for most of its existence back in the day, which was tricky for people to manage who traded there. I never traded there or anything, but because you get your actual position that you're collateralizing, which could be volatile, which is usually leverage Bitcoin or something like that, or some altcoin you were trading. It's moving. You're managing that risk, but also the structural value of your underlying collateral is volatile. And by the way, in crypto, a lot of times that was highly correlated moves too. So you could lose money on your position at the same time as your collateral value is dropping, right? And have to scramble. So I think, I don't know, but almost all of those exchanges have changed to stablecoin collateralization for that reason.
But you can do a lot in DeFi, frankly, with stablecoins, because as a stable, unit of account, you have fixed LTVs. You don't have to think about your LTV anymore to the point where you get. And, we'll see if this happens with Bitcoin too. Like it's uncomfortable, but, Bitcoin is the third largest collateral type in DeFi. If you think about all
Which is basically like what, wrap Bitcoin and like other versions of that, TBDC?
Mostly, wrap Bitcoin. But it does function as one of these, a few areas in the industry, beyond trust minimize like currencies and stores of value like Bitcoin. One of the few applications that have actually gotten product market fit at this point.
Is what on-chain leverage and lending, you mean? Like collateralized lending, basically?
Collateralized lending, especially with stablecoins, because then your liquidations are fixed, and you can get leverage in a much more, in a much safer way. And that's kind of this irony of DeFi as it exists today, right? Its main value proposition is risk management, because you don't need to rely on like a 400-page contract to an interpretation of that contract to move collateral around.
You can be pretty sure exactly how it's going to play out under different scenarios, right?
Exactly.
It may have no leeway if you need it, but you'll know for certain that you don't have that leeway, so you can prepare for it, right, or whatever.
That's exactly right. And think about it from a cost perspective too. If you were to executing these contracts in the real world and rely on court systems is incredibly costly and tough to navigate a lot of times depending on your jurisdiction. In crypto that's a lot simpler, and I'm excited. I'm an optimist, especially with regards to Bitcoin. We'll see what starts coming to Bitcoin on that front.
Well, let's talk about that a little bit too, because you mentioned ordinals before also, and there's, I think it's fair to say there's a bit of a culture clash happening in Bitcoin. Yeah, I still think the monetary maximalists, the digital gold crowd is the dominant culture in Bitcoin, but probably like never before, or at least not for many years, there is a resurgence of Bitcoin as a platform for building other things.
Right.
You've got ordinals, which is, I think at its base layer most people think of as NFTs, but actually the vast majority of ordinals were weird token things, BRC20s, right?
BRCs.
Then you also have Drivechains. Big debate about Drivechains. I don't know if you have a take on Drivechains.
I do.
Okay, I'll give it to you 1 second. And then just to round this out here, there's also a lot of people trying to build roll-ups on Bitcoin. So let's, rather than attack that entire question, what is your take on Drivechains, by the way?
Drivechains, I've been following Paul's work for a really, really long time.
He published these BIPs, in like 2017?
Yeah, it was,
a while ago.
Or maybe 2016.
These are 5 or 6 year old proposals.
They're old, and I think it's been discussed quite frequently, even back then in terms of their feasibility. I think now that there is kind of this cultural bifurcation in Bitcoin of where is the protocol going from now, I think it's gaining more traction, and a lot of context is required here, right? We had this whole conversation around CTV and its activation, and that was very traumatizing even for like Jeremy to go through. And in kind of the tail end of that, you have this conversation around Drivechains. I think one lesson that kind of blew my mind around ordinals is around unintended consequences, right? What I consider one of the smartest people in the world worked a ton on taproots and really didn't see how loosening what you can actually encode in the signature part of a transaction, what that would actually be used in the wild. So, and that, although when ordinals launched, people thought that it was the end, right? You could not run a node anymore, and
which didn't end up being true, but
which is not the case whatsoever. We've modeled that out.
And your point is that when Taproot was activated in the chains, they relaxed the limits on how much data. They removed the limits, I believe, on how much data you could put in the witness section of the transaction, and then along with SegWit, which also makes any data you put there less expensive.
Right.
You mean that they didn't realize that this would happen, right?
Yeah, or that
I agree.
It would get used for
I think this is why
NFTs.
The community, the Bitcoin broadly community, was caught completely off guard by this. Casey Rodarmore dropped this bomb. Nobody knew it was coming.
It was like
I think it's actually quite bearish for future BIPs in general. Like the fact that there weren't again, not every person can be expected to have the technological capability to review these types of proposals, but so you rely on the smart developers to talk about it, and you can participate and certainly follow the conversation and debate, and it didn't come up once.
It did not. It did not.
And I think, frankly, if you had told Bitcoiners upgrade to Taproot and we'll get never-ending NFTs on Bitcoin, they would have broadly opposed it.
Absolutely, and I think it was done very quiet. It was a little bit of a secret. I shouldn't use the word secrets, but it was only for the astute observers that were looking at this loosening of the rules that questioned this design decision. Like, why would you even do it? And based on some conversations that I've had, the reason was they were future proofing for new proof sizes. Like they thought, oh, maybe there is a way that you can, put a zero knowledge proof on Bitcoin. Maybe there are, novel
like Musig and these other weird new tap script things,
signature aggregation. Right. There's all of
You're
these
gonna need
different
more space in there for weird crypto things, for cryptography things
that were
not
completely valid. Long and behold, what was that used for?
Yeah,
it's NFTs, right? So I think there are unintended and unpredictable consequences that shouldn't be dismissed. I think both with CTV and with Drivechains. I am more pro CTV, and there was even a blog post I think has been retracted, but on how one could implement Drivechains using CTV. But I think, in my view, because of these unintended consequences, because the ultimate end result of Drivechains would just be more tokens, and more tokens, although I'm not saying that there's no value in tokenization, I'm not making that more maxi article comment. I think there is a lot of interesting use cases, as we just discussed, on tokenization. It would take a long time for Bitcoin to replicate a lot of these more DeFi tokenization use cases to the point where that might not be the best use of our time and resources, given that there are potential for unintended consequences.
Yeah, I hear you. I think that's a very fair take and way to think about it. Drivechains are merge mined side chains, essentially miner custodied.
Yeah.
And that have what 301 has a peg in and out mechanism built into. So that it can mess with mining economics. There could be unintended question. I mean, I think this was Casey made this point really well, actually, was that I thought in a way that I finally really understood the risk, this part of the risk, which was that it creates just other externalities, and miners start, by the way, you get really good at it. It's like MEV. It's like MEV in that you centralize, and we're seeing this on Ethereum now, which is the verticalization of block building and MEV. Like all the best block builders are doing the MEV themselves, right? It's not the Flashbots thing isn't working exactly as intended. It is making it so that anyone can do MEV, but who's the best at it? Who can hire all the devs to come up with new algos and find the strategies, right? And the same kind of thing could happen here. And again, I'm not even sure if it's that bad, but I'm unsure. There's a pretty big unintended outcome possibly that could be dramatic.
I think this.
I don't know if it's bad. It's something though.
I think you hit the nail on the head. I think this would really bring in some novel MEV strategies to Bitcoin that I don't think we're ready for just yet.
Yeah, Eric Wall made this point really well too. I think Bitcoin 2023 is one of my favorites for him and Udi's Taproot Wizards thing, where they had Shinobi and Matt Corallo there too as like the anti, although they were all pretty reasonable, I thought, but it was pretty funny. But he said that Bitcoin developers have no effing idea, he said, how to do anything related to MEV. Ethereum communities spent the last 5 years trying to mitigate it and remove it from the protocol. Yeah. We don't know anything about it. He's like, we're completely unprepared for if that were to happen, like what to do. Bitcoin, well, they'd have to go and learn from the Ethereum community.
Yeah, it's interesting.
Bitcoiners are loath to do that.
Yeah, because, you can think about the block wars as a war around MEV, right? I think I wouldn't say that, Bitcoin developers don't really understand MEV. I think the definition of MEV is obviously very different for Bitcoin than it is for Ethereum. Like one simple way of thinking about it is, in Ethereum, the transactions in the block are executed sequentially.
The order matters.
The order matters absurdly, right? It's everything.
Yeah.
Whereas in Bitcoin, everything is atomic. Either all of them execute at once or none of them execute at all.
Right.
So there are different ways that miners can extract value if they're trying to do MEV in Bitcoin. MEV was actually born in Bitcoin.
Right. Absolutely.
The first MEV project was via BTC's transaction accelerator. I think they launched back in 2014. And if you broadcast a transaction back then and you got stuck and you didn't do RBF, the recipient couldn't do child pays for parent, like two mechanisms that you can expedite, the settlement of a transaction. You could go on their website. I think you can still do that.
I think you could like pay with a credit card.
You pay with a credit card.
You literally give the mining pool money and they just include it.
Yeah, that is a way of extracting value with, and if you look at their block templates over time, they always have less transaction fees than others because they are also accepting transactions so-called out of band.
Yeah.
So I think MEV has existed in Bitcoin. If you think about the block size wars, miners were pro increasing the block size because they saw that as an opportunity to extract more value. And in a lot of ways, user-activated soft forks are the ultimate weapon against MEV, and it is a very much Bitcoin culture aspect. So I think Bitcoin developers, I think they're familiar with like this kind of division of powers. Is just they don't understand from a product and use case perspective how these things materialize. I think that maybe that's what Eric meant, because they're not really tuned into the Ethereum ecosystem where these things tend to appear first, right? Things like DeFi.
Yeah, I think
like
he just means they're
NFTs.
behind. But it's not that they can't understand it. It's that they haven't been following it.
Yeah.
And they've learned a lot of lessons in Ethereum for the different ways they've tried to mitigate it and seen how it's played out. There's a lot to be learned there.
A ton. And it's interesting too because in a lot of ways it starts, there was this meme back in the day that, Litecoin was Bitcoin's testnet.
Oh, yeah.
No.
Silver to Bitcoin's
Right now,
gold, testnet, BTC, yeah.
Ethereum is, Bitcoin's testnet.
Yeah, especially if we start to see roll-ups and stuff emerge on Bitcoin, then it really will be like we waited until you guys finally came up with the ZK roll-up, and now we're going to implement it.
Exactly. Yeah. And by the way, I think if you think about
There are
long-term,
two projects building ZK rollups using sovereign rollup style. Kazar Labs and Chainway both are planning to release a Bitcoin ZK rollup.
Yeah, I'm following those projects.
Yeah.
It's all about, I think how do you connect them to the chain? That's a little bit more controversial, right? And are they actually, could the actual users have some assurances of, Bitcoin security being applicable to that? And that's a little
That's
bit
tough,
trickier.
yeah, especially with no change. I mean, this is why I think 301, the Drivechains is 2 bips. The second one is a trustless peg in, peg out mechanism.
Yeah,
I don't actually like that mechanism
Yeah.
he's designed much personally either, but it's again he sees that need as well.
Exactly. And I think, directionally, I think we should embrace these ideas. We can disagree about implementations, but I think just to dismiss them and say, "Oh, I don't want to see any, shitcoins on Bitcoin," I think it's really undermining a lot of the value proposition that we've seen emerge in things like Ethereum as it relates to, lending, as it relates to actually not trusting a third party to custody your Bitcoins, which, wrapped Bitcoin, the third largest, collateral type in Ethereum, is really just a big third party that's holding it and doing more without really losing custody, which is, I think, a very cyberpunk kind of thing to
It is.
to
I really
aspire to.
agree. I love Bitcoin and I want to use my Bitcoin more.
Yeah.
It doesn't mean I want to buy cat JPEGs necessarily, but who knows? I would like to. I want Bitcoin to be more full featured. Another thing people point out a lot is we want things like privacy, better privacy in the world. By the way, I don't even mean on
not
Bitcoin.
just
Like
this
privacy
context,
is a multi-generational battle that has been being fought and will continue to be fought. I actually had an FBI agent on this show, Chris Tarbell, and a former FBI agent, and he I asked him this question about the battle between like Apple and the FBI during the San Bernardino shooter thing, and then the Clipper chip in the 90s, and like how it's the same battle just constantly being fought. And I was like, are we destined?
Yeah.
I asked him if we were destined to fight this battle against government forever, and he said, I hope so. He's like, because I hope they don't win. He's like, we deserve to have this. Yeah. Anyway, point being is it doesn't even have to be altcoins that get built on Bitcoin. It could be a privacy L2. It could be a there's uses that we should be able to play around with. I would like personally.
Yeah, I would too. And if you think about this concept of Ethereum as Bitcoin's testnet. In Ethereum, I think it was during the Byzantium upgrade of 2018, they introduced an opcode that verifies zero knowledge proofs, right? It's gotten tested in the wild multiple times. We're now seeing ZK rollups being launched on Ethereum, testing these different functionalities. There are a few projects that are looking at the privacy end, because ZK rollups you can use for both privacy reasons and efficiency reasons. You can batch validation of transactions. And that tends to be, a lot more of like an Ethereum use case, because scalability is kind of critical there.
Yep.
But privacy, you're absolutely right. I think if we think long term and beyond just like very use case driven, proposals like Drivechains, and think about ZK rollups that could be used for privacy, scalability, composability, functionality, all of these different things jammed into one, I think it's a lot more interesting, because the only thing that this new hypothetical opcode would be doing is just validate something from the outside on-chain, which is, I think, a lot more scalable, and it does limit what actually happens. You don't have to actually, change any sort of scripting within Bitcoin itself. It's just really a validation mechanism.
Yep. It's going to be exciting. Before we wrap, one last question. You've been in crypto quite a long time, as have I. Where are we in this long bear market? How are you thinking about, really, as a long time Bitcoiner, crypto researcher, analyst, like how are you staying not cynical and I mean, there's a lot of interesting stuff happening, and maybe that's the answer, but where does it feel like to you?
This is probably the most painful. I remember the aftermath of Silk Road shutting down, where to be involved in Bitcoin was to be a criminal, like in the public eye. Still, there was a strong cohort of people that believed in peer-to-peer markets and in freedom. 2017 was a wild year. Like, you had the proliferation of ICOs.
Went really from like $600 Bitcoin to $20,000 Bitcoin that year.
Exactly. And then you had the aftermath of all these projects collapsing.
Lots of scam ICOs and stuff. Even ones that weren't scams, also many of them failed, right? I mean, a huge, it was like a huge burning hot and then fading, right?
Exactly. And then you always kind of default back to, why the hell does this technology exist and excite you? And I think this bear market has been particularly painful, because now I think the previous bull was when crypto went mainstream, really. And it went mainstream maybe for very bad, reasons. At least like the perpetrators of the collapses of massive failures.
And even like the wide adoption at the time too. It wasn't for necessarily the core things that we know make it core value, right? It was JPEGs. It was just pure naked speculation, like casino type game in the scheme of things, right? Unfortunately, we didn't really explain to the millions of people that came in to Jimmy Fallon on TV holding up his NFT. He had an NFT, couldn't tell you a single thing about why decentralization matters. That's what really was sad about it to me in retrospect, was it was a mania, but we didn't. And of course, we've got more. We did bring in more true believers. That cohort is growing. It never stops growing.
The user base, by any metric, has drastically increased. I think the challenge is on the use case front, right? What is it that we're solving at this point? And I think we're at the max pain, stage. It is, I think, going to be very painful, even like going into the halving, if prices don't really recuperate as things go through.
Painful for miners potentially as well.
For miners, I think for a lot of these newer projects that may be raised and are kind of extending their runways, like layer 1s and layer 2s that are coming through. So I think there's still some pain ahead, but I think there's still, I always go back to this cohort of users that have been around for a while, that understand this technology from a really deep perspective, and that understand how it's going to be important moving into the future as, a fundamental, sovereign technologies. So.
Fascinating. Great discussion. Lucas Nuzzi from CoinMetrics, my friend. Thank you so much for coming to New York and coming on Galaxy Brains.
Thank you, Alex. Always a pleasure.
That's it for this week's episode of Galaxy Brains. Thank you to our guests, Lucas Nuzzi from CoinMetrics and Beimnet Abebe from Galaxy Trading. As always, lots happening in crypto data analytics, a whole new data set and type of data set to analyze and impact markets. We'll be watching it closely. For now, have a great weekend, and we will see you next week. Thanks for listening to Galaxy Brains, the weekly podcast from Galaxy Research. If you enjoy the show, please like, rate, review, and subscribe wherever you get your podcasts. To follow Galaxy Research, sign up for our weekly newsletter at gdr.email, read our content at galaxy.com/research, and follow us on Twitter at GLXY Research. See you next week.